Hey guys, we're recording. You guys can continue if you want to be recorded. So let's look at where we left off. So we're going to just finish unit 5 with the last set of notes, cost of equity here. And let me check something. Okay. All right, there we go. Okay, so we're back to the UAIR case, and I've given you a bunch of data on the UAIR case. Let me show you if I have it here. UAIR case part 2, it's called. Maybe I don't have it. UAIR case part 2 is on the platform as well. Just showing you everything is there. So it's right here called UAIR case part 2. And it provides you information, additional information on UAIR, and asks a bunch of questions. So UAIR is that American airline. In 2010, the airline was considering opening a new line to the Bahamas in the following year. UAIR's long-term bonds are currently traded at 6.04% annual effective yield to maturity. And the current T-bill rate is 1%. Returns for UAIR stock, the S&P 500 index, and 90-day T-bill for that year are given. So this is all the information given. Now from here, I ask you to use CAPM and then also to use the dividend growth model to estimate the required rate of return for UAIR stock. So where do you start? So to do CAPM, you need a beta. So you start with the beta. How will you calculate the beta? What do you need for calculating a beta? You need the market returns and the firm's returns. So which ones do I use? What information?
Return be the S&P 500.
Yeah.
And the T-bill. Oh,
No,
no,
and the
US
firm
stock.
return and the stocks returns. Okay, so put those in your calculator and get me the slope. That's the beta. I'm gonna do it too. I enter as X, I enter the market returns. And as Y, enter the stocks returns. I think I made a mistake. I'm on 7. I made a mistake. Okay, go back.
Why there? 7.
Why are there 7?
I think you enter like 7 variables. Right?
Yeah, I made a mistake. Why don't you guys do it rather than watching me? It's more meaningful if you do it. I've already done this before. I think it's here. I made the mistake, 0.1506.
The beta is 1.552.
Right. And then second stat, and you work through to get the B. And the B is there. 1.55444. Something's,
You have 552.
oh, maybe I entered something wrong then, because that's
Yeah,
not
yeah,
likely. And that
552.
552 makes more sense, makes me remember. Okay, so I'm just gonna review my numbers. That's wrong. Yeah, that's my mistake there. 5, 4, 11, and then 0.37. Anyway, you guys got it, right? So forget it. I don't have to do this again. So enter the values and get the beta. And the beta is 1.552. So now we're using the CAPM to calculate the, with the beta, calculate the expected return to U air. So using the other information, we want to get the risk premium, right? So expected return we got for the expected return to the market on your calculator, you have 5.11% or 5.12%. Returns to U air is 11%. So for the CAPM, we need the risk-free rate, which we were told is 1%. The current T-bill rate is 1%. We have the beta 1.552. And then all we need are these two things here. So I have a lengthy discussion about why I do this differently. Rather than just putting the T-bill, the market return here, 5.11 or 5.11833% in here, and then the average T-bill rate here, instead of doing that, I calculate what I call the average historical market risk premium. So I just get the average over this year, which we already got, minus the average T-bill rate over this year. And I get the average historical market risk premium. So Something different here is that the RF is not constant, right? Even though I'm gonna put here the current T-bill rate, because remember the logic is to be incentivized to hold UAIR, investors demand a return, or they require a return higher than the T-bill rate by a multiple of the market risk, the market risk premium. So I'm going to use the current T-bill rate because that's the one I care about. But then to estimate the market risk premium, I'm going to use recent history, because the recent history of this episode was very strange.
My question to you is, the 2.365% was given, or we have to calculate?
It's from here. It's the average of these numbers. It's the F bar is the average of the T-bill returns. So you calculate that, and then you estimate this is a return to UAIR. So the only different thing here, the only like surprising thing is I didn't give you RF that you can put here and here. I defend that I'm going to use a different market risk premium because it's a weird time. So that 5 years was a little blip in history. So I'm going to use those years. So anyway, if I ever ask you to do that, just do the same thing. But otherwise, you just put RF here and RF here. But in this case, they were different. Okay, so you get 5.27. How do you reflect on that number? 5.27. What do you think about that? What was UAIR's required rate of return? If you go back or you think about the notes, what was it when we did UAIR? It was 10%.
It's below that.
Huh?
It's below.
It's below. So what's the effect of that? What's the effect when the discount rate is lower or the required rate of return is lower? You're still going to accept the project. If you remember, the internal rate of return was 10.26 when we calculated the UAIR case at the end. It was 10.26. So this required rate of return is even lower. So we're going to pick UAIR. We're still going to go with the Bahamas project according to this required rate of return, but we feel like uncertain. Oh, it's so low. Like, how could we get it so wrong? So let's estimate it a different way. Let's use the dividend growth model to estimate it. First, though, I'm going to try changing the years I use to estimate the market risk premium. So I'm going to use all the years that I have. If you remember back the notes for the beginning set of notes for risk and return, I'm going to use all the data. And remember, in that data, you can check the expected return for S&P 500 was 3.7%, or a measure of common stock returns. And the T-bill rate was the T-bill rate was 3.7, and for common stock returns it was 11.3. So this is the information from that. I'll just show you where I'm going from. It was the risk and return data. It was this stuff here. I said 2010, but okay, it's 2008. So I guess I have different estimates. So remember, I calculated the expected returns during different periods of time. And I guess I did it. I got the data for up to 2010 and estimated again. The numbers are all very similar. So I got that, and I'm putting in for this period up until the current day, 2010 at the time, 3.7%. And for the market, 11.3. And I get this as the average historical market risk premium. And now I have, using the CAPM, I get 12.79%. What do I think about that? What will happen to the Bahamas project? There's a couple of numbers you guys have to remember. The IRR of Bahamas was 10.26. What does it mean?
This project,
No. What does this mean? What does that 10.26 mean?
the rate of return and invest in the project, that will be 10.26%.
Very good. So then, but if this is the required rate of return, what should we do? It's not high enough. It's not high enough. We reject. So now we have a very difficult decision to make because one estimate says accept the project, the other estimate says reject the project. Which one do I choose?
The IR,
No, but which estimate do I choose? This one with 12 or this one with 5? Those are your options. So
well, I will choose the cost of equity since it's.
they're both cost of equity.
I know, but my case, if you're choosing the IRR or using cap M, to me, it seems that the American, how much return you're gonna get instead of how much equity you invest. That will be my.
Well, okay, this is from the capital budgeting exercise. This one is using the cost of equity, but using a different set of years. This is the decision you have to make. Which set of years should you be using to estimate the average of the historical market risk premium? Well, I recommend that you use the most recent set of years because that's more likely to dictate what's going to happen in this strange time than to go over all of history. So I stick with this other number, this first number, because the last 6 years is more current data, and for more robust, reliable estimate of what's happening right now, it's better to use the more current data. So that's my logic in keeping 5.27.
We're gonna use 5.27, right?
But first, I'm going to make one more calculation. So I'm going to try and estimate it a third way. So this is method 1. I'm going to call them methods, but so this is option 1. This one is option 2. And this one that we're going to do is going to be option 3. I'm going to do this with the dividend growth model. So I'm going to remember the dividend growth model assumes constant growth rate of returns. So it's basically forcing us to use the growing perpetuity formula. And rather than looking for the price, I'm going to look for this using the current market price. So that's what I'm doing. So I'm going to force G. I'm going to say there's a constant growth that's going to continue forever. How am I going to find G? Well, I have to use the most recent data. So I give you this information as well. So with this information, can you find G? How do you find G with this information? So what I do here is I force G to exist by saying that the first one in 2005 with 6 years of growth will give me the last one in 2011, the upcoming return. So I know the dividend is going to be in 2011, 25 cents. So I give you this whole table. So to find the G, then there has to be 6 periods of growth between the first one and the last one. So I can solve for it here. So it feels like kind of like you're solving for an interest rate. You're solving for a rate, the growth rate. So once you have the growth rate, you can use it to estimate the next dividend. So for 2012, where the price in 2011 is $10.25, I give you this information as well. I'll give you everything except for I and G. So G you can compute from the information given, and then I you're going to estimate it as the cost of equity for UAIR. You put all these numbers in. I don't know, you guys should try putting it in. I don't know why you guys are here. Put these numbers in and see if you can get the number. Try this. Don't watching me, you could just watch, you can just read the notes. So try it while I'm here and let me know where you're stuck. So let me pull the information together. Okay, so what do you have? To find the dividend next period, I'm going to use the G that I found, and there it is, it's 26 cents. Or I can use this whole estimate because investors will buy, this is per share, dividend per share. So investors will buy more than one share. So we could use the extra decimals. So if they had, 1,000 shares, then they would make $259.47. But per share, it's going to be this number. The price, I give it to you, is this one. And then the G, I've calculated already, is here. That's it. What do you get? Okay, so you get 632. Now this will be number 3 option. So I've estimated, I'm going to estimate more. So this is the dividend growth model estimate. It's 6.32. So how do you feel about that? So what do you think? No comments? So we talked about 1 and 2, and I said we pick 1 because it's using most recent data. So 1 was 5.27. The third one is close. It's close, and it doesn't change the decision. We still pick the Bahamas project because it's lower than 10. It's lower than 10.26, which is the IRR, right? The IRR has, so everything is being compared to the IRR.
So comparing the first one, the third one with the second one.
Well, I'm asking you to say, I'm just asking you to comment. So what do you say? This one is 6. We're still gonna pick UAir. I mean, the Bahamas line is gonna still be selected because it's still higher. If we use this one, it's still higher than that. This is the IRR. So continue, proceed with the Bahamas line. So it doesn't change anything. So because it doesn't change anything, now I'm gonna ask you, which one should we do? This one, 3 or 1? Which one should we settle with the cost of equity? This is the kind of thing you guys gotta do. Calculate and interpret. So what's your interpretation? They're not that different. Does it matter? Doesn't change my decision.
Just shoot which one, but we're still gonna make it.
So you got to think back to the model. Okay, we made assumptions here. We made assumption that the growth rate will be constant forever. That's a pretty strong assumption. We made an assumption that well, I guess that's it. That's the big assumption. If you're comfortable with that assumption, this is fine. If you're uncomfortable with that assumption and you feel more confident with the CAPM estimate, you go with the other one. That's the thinking. Okay, to use this, you have to be confident that this firm will grow forever at G. So that's what you're thinking about. So I'm going to continue. I'm not going to do that because I think that's a strong assumption. I'm going to stick with the CAPM result of 5.27. All right, so then I'm going to go back to the data for UAir. And the UAir data is here. Remember, these were the cash flows we calculated back in unit 4. And I'm going to, it's still, the IRR doesn't change because the cash flows don't change, right? The projection of cash flow stays the same. Using 5.27 now, I will calculate a different NPV, but as I explained, this will also be positive. It won't change because we just went with a lower number, which makes NPV even higher. However, if we use the number 2 estimate, we would have rejected the Bahamas project. Okay, so you got to think about all the options. There's so many ways you can estimate this. You got to be the one who decides which one is the best, or you have to make recommendations to your superiors which one is the best. Okay. And there's some of them are different. Like this is very different. When they're the same, nobody really cares. When they're similar.
So we use the lower R.
Well, not because it's lower. We use the lower one because we use the logic and said, remember what I said here. This is very different from if you use the last 6 years of data. This discount rate makes it less likely that the project will be accepted. When these are different, the convention is to use the more current data. So use something more current. So I just use the last 6 years rather than going into history. Okay, because things have changed. It doesn't, the last 6 years do not mimic history. So I will rather use the more current data to get a more current estimate with the bizarre fluctuations and volatility. All right, so think about that, 1, 2, and 3. And let's put this now onto the security market line. On the security market line, we see it's way off. How do we conclude that it's way off? Here's UAir with this level of beta. This is the required rate of return for the firm. We did use the CAPM to get this 5.27 figure. But the fact that the Bahamas project is up here, what do we do with assets that are up above the line? They're undervalued, so we should buy them and hold them. In this case, the project should be pursued. It's valuable. Okay, so this is the approach. This is a strategy. This is a strategy for investing, looking for projects, making decisions, valuing assets, valuing projects, valuing firms. You're looking for different approaches to estimate and reasoning if they're off of equilibrium, if there's just some value there, and there is value here,
So is it undervalued?
because it's above the line or undervalued. I explained that last class, right? Assets above the line are undervalued. So have a look at that. If I have time, I'll go and explain this again, but we have so much to do. I'm on page 8 and I have to get to 20 and do a long problem. Okay, so assets above the SML, they're out of equilibrium and they're undervalued. When assets are undervalued, you expect write it like this. When they're undervalued, you expect the price to rise and simultaneously to maintain equilibrium, where this is the dividend. This would be the dividend. It's the same relationship, but different numbers I'm putting in there to maintain the relationship of a steady dividend payment. The expected return will fall and put us back on the line. So assets above the line are undervalued. The ones below the line, so when they're undervalued, you should long the assets or buy and hold them. Long is to buy and hold them and realize the price rise. If they're below the security market line, you should short them. You borrow them, borrow it, any asset that's below the line, you try and borrow it. And the price is going to drop because they're overvalued. As the price drops, you can take advantage so the price is going to drop, and simultaneously, to maintain the constant dividend, the expected return will rise and put us back on the line. You'll short them because the price is going to drop. It means you're going to borrow it from a broker who thinks differently than you, and you're going to sell it on the market, use the proceeds for, as I explained before, investment in the market portfolio or do something else with it. And then when it's time to return it to the broker, the price will have fallen. So you realize a positive payoff. So this is the story of the SML. Okay, so all we've done here is assume that UAIR was an all equity firm, but what if it wasn't? What if UAIR also had debt? So it borrowed money from investors and has credit holders and has commitment to pay interest payments to those bondholders. How does that change things? Well, we are going to take into consideration now that the asset valuation, what the firm owns is equivalent to what it owes its financiers. So we have now stockholders and bondholders, and I'm going to introduce the idea of the average investor, a person who is, or investor, individual who is part stockholder, part bondholder in the same ratio as the firm is invested or financed. So I'm going to show you all this new notation, but anyway, we use it a lot in Unit 6, but I'm not going to get to Unit 6. So the value of the assets of the firm are S plus B. These are the market value of the assets. So this is the total outstanding stock valuation. This is the total outstanding bond valuation. S, as I said, is the market value of outstanding stock. the return on equity, RS, is the cost of equity that we've been estimating so far, like the beta S that we've been estimating so far. So this is the return and the risk of a firm, okay? From the firm perspective, they require this rate of return in equilibrium because that's what they have to pay to stockholders. All these results are in equilibrium. So there are no supernormal profits. I don't know if you guys understand that, but this is the efficiency argument. So this is the same. What they expect is what they have to pay out. And this is the beta. And these are mapped through the capital asset pricing model, one to the other. So now we introduce debt, bondholders. B is the market value of outstanding debt. RB is the return to debt, or the return to bonds, cost of debt. What would be RB? That's the yield to maturity. Bonds, go back to bonds. So you can't forget, as I explained, you need to know all this material. You need to know annuities. You need to know bond valuation. It's all like, it's not partitioned. Even though I gave you 3 tests, you need to know it all for the final. And beta. All right, so
periodically get forward, and then it's just both sides. So as time goes on, let's say that more payments are made on the bonds.
no,
less
the return
bonds.
is during the term of the bond. This is the same yield to maturity. It stays the same. Okay. We're gonna do some exercises so you can see that. So the firm's assets are V, the value of the firm, are equal to what it owes, S plus B. I'm going to also refer to the return to assets as the returns to the average investor in the firm. And I refer to the firm now as a levered firm. So there's leverage. The firm borrows money, and this is what we call it. So it leans on, or it leverages to function. So this is the terminology for a firm with debt. And this is beta of assets. This is the systematic risk of the levered firm. So it's the risk to the cost of debt. So this is the cost. Oh no, this is the cost of assets. So this is part equity and part debt. You'll see what I mean when I get into these ratios. So here are these ratios. So what's this? This is the ratio of financing that is equity. This is the ratio of financing that is debt. If it's an all equity firm, this ratio is 100%. And the debt ratio is 0. If it's an all debt firm, debt ratio is 100%, and this is 0. But for a levered firm, the average investor is invested partly in debt and partly in equity. These are the ratios, and they're both positive. So the average investor is like a representative. It might not exist. The person might not exist. It's just a theoretical concept of an individual who is invested in the firm, just like the firm is financed with these same ratios. All right, so, oh, I touched something. So we have this, okay, just repeating myself. S is the market value of outstanding stock. RS is the return to shareholders. B is the market value of outstanding debt. RB is the return to bondholders. And simultaneously, this is the required rate of return for shareholders, right? So it's what's paid to them and it's what's required by them at the same time in equilibrium. So, and then we have the average investor in the firm. So we have now arrived at WACC. So I've got you to this point where I'm going to say, if you have an all equity firm, the return to assets is just the return to shareholders because all the investors in the firm are shareholders. If you have an all debt finance firm, the investors are only bondholders. So the return to assets is only RB. But if you have both a bond and stock investment or financing, the average investor's return will be called the weighted average cost of capital, or WACC. And that's what we're gonna focus on now, okay? So how do we calculate the WACC? It's a weighted average. It's the weighted average of all the returns. I put different symbols on them, but basically, here's your weight for the return to shareholders, and here's your weight for the return to bondholders. That is clear, I think. So weight times return, weight times return. The only strange sort of thing here is this. How do I explain this? What is that, first of all?
That's the
That symbol,
period before,
no, there's no periods here.
secondly, and third.
I know it's used for income purposes.
Right, so when I put that, I always say after tax, right? This is the after tax. Right, so is this number, so if I put 1 minus TC here, does this number become smaller or bigger?
Smaller.
Becomes smaller, right? Because, so it's usually, if TC is 40%, 1 minus TC is 60%, so it's a fraction. So this becomes smaller. So from the perspective of the firm, they pay less, right? They're going to pay out less. So this is required by the investor. Sorry, this is the cost of capital. This is an expense to the firm because they got to pay shareholders, they got to pay bondholders, but this goes down. It goes down because interest payments are tax deductible. Interest payments are tax deductible from the firm's perspective. So there's like an incentive for them to take bondholders because bonds holders reduce the taxable income. Now you have to trade that off with the risk of having to pay bondholders and how shareholders see that, right? So there's like a inherent concern there. If you can't pay bondholders, you have a real problem. Shareholders, you don't have to pay them all the time, right? You don't have to pay them dividends, but they will leave you, they'll sell their share, and you know, there's a risk of the value of the asset going down if that happens repeatedly, and there's a perception that the value of the firm has fallen. But if you have to pay bondholders, there is a risk there, but it's a trade-off with the reduction in what you have to pay in taxes. Okay, so how do I get this term? So I take, they like make some notes here. The firm pays bondholders interest payments of RB for every dollar invested. However, the firm also incurs tax savings of TCRB. So this looks like tax shield, right? TC, when we did the tax shield for depreciation was TCD, now it's TCRB for every dollar invested. Therefore, the cash outflows of the firm to its bondholders and the cash inflows to bondholders of the firm for each dollar invested will be RB minus, so they pay this out, but then they save this in taxes, so this is where that comes from. I put it there. This is for every dollar invested, they have to pay the bondholders this. So for every dollar of debt they issue, they've got to pay bondholders this, and then they get to have a tax shelter of this much, or tax savings of TCRB. So when you do the math, for every dollar invested, they only really have to pay out this.
So essentially it costs them less.
Costs them less.
Because they have the tax shield.
Exactly.
Or they reduce, technically,
They reduce
the
that per dollar payment. All right, so that's where that comes from. And all right, so that's that. Okay, any questions there? So all I've done, that's a weighted average. It looks really different, but it's the weighted average. It's different looking because the way I get the weights is not me giving it to you. Well, sometimes I'll just give it to you. I'll say, the proportion of equity outstanding is 53%, and the proportion of debt outstanding is, you know, of the value. So I can give you that number as one number, but I can also give you S and B And you'll see we're gonna calculate all of it with our final problem. If we ever get to it. Okay, we're almost there. So what about, so when we think about CAPM, we always think risk and return. So here's the return. What's the risk? All of this should also be mapped easily onto the capital asset pricing model. I should be able to put this onto the SML. So here's beta. The beta is also a weighted average with the same idea of the weights. So the beta of equity, hold on, has this weight.
Professor, it looks really similar to the 49.
It's the same mathematics and statistics. Yeah, it's the same statistics, exactly. So I need to say something here just to be, so I didn't put the 1 minus TC in here. It's coming. It's because I just touched the iPad and then something jiggles there. I don't put the 1 minus TC here, but you should understand that this beta, the beta of debt, is the after-tax beta. What am I talking about? So in the CAPM, no, that's not what I want to do. Okay, so the return to debt. The return to debt, as I did here, should also be pre-multiplied by 1 minus TC, because that's per dollar what is paid out, right? After all is said and done. So in terms of the CAPM, in terms of the CAPM, so if that's, okay, so let's remember the CAPM. I'm gonna just do it like that. So the CAPM is expected return to I equals beta, not beta, RF plus beta times the market risk premium, right?
So we expect the return of after tax, the return on that equal to market risk-free rate.
Okay, let me finish this. Okay, so this is okay, so this is the capital asset pricing model right here. Is everybody okay with that? That's the line the SML makes. If I want to write the relationship between the return to debt and the beta of debt, this is the relationship. Okay, that this is the capital asset pricing model. This is from what we were doing before. I'm not going to go back now because I have to finish this, so you'll have to look back.
After tax, right? The pricing model after tax, right? That is just model that you have below that, the small.
Sorry?
Okay, you have the SML, which is the.
So this is the SML here. This is the SML.
After tax rate, right?
This is just about the B. I'm just talking about RB. I'm talking about this. And I'm trying to explain that how do we take account of 1 minus TC with the beta? Because I've just written that the beta of assets is the weighted beta, just like on the SML, you can get two assets mixed together will end up also on the SML. So you're going to have the return, which is a weighted return, and you're going to have the beta, which is a weighted beta. Anyway, it'll make more sense when we do the exercises. So my point of saying this is the after-tax beta to be able to do this for the beta of assets after tax. You'll see it in the examples that I give you. I gave you examples of this. You have problems to solve. Okay, so what's the point that below is that debt is very low required rate of return, right? It's lower than equity. If you remember back to the tables that we looked at here, and we looked at long-term debt, it's much lower return than stock. You guys listening? These are lower than stock, and also their risk is lower than that of the measure of risk for stock. So we expect the debt, the low return on debt and the low risk on debt. So the beta is actually close to 0. So if the beta of debt is close to 0, what does that say? So if this is 0, let's just make it 0, the extreme, make it 0. And then looking at this, the beta of equity, so that the risk on stock is higher than the risk on assets because the beta brings it down. I mean, the debt brings it down. So the return to debt brings down the average return or the weighted average cost of capital. You're weighing, you remember on a line, right? When we added a low risk, low return asset with a high risk, high return asset, we end up in the middle, right? On the line. You guys don't remember? So you end up in the middle. So what is that doing? That debt is making it the risky one overall less risky because it's coming down the line. So that's what I'm saying there. All right, so let's look at this problem for UAIR. For UAIR, we are introducing now the fact that they also issue debt. So they issue debt, and we can now calculate the WACC. And I tell you in the case that, so in the case here, now you assume that UAIR is a levered firm. Number 3, it has debt on its balance sheet. Given that 53% of its assets is financed with equity and 47% with debt, estimate the weighted average cost of capital for UAIR. So now we go back and do that. Here's my 53% equity, 47% debt, and then there's other information that I give you at the beginning of the case that 6.04% is the cost of debt. This is the after-tax amount, and this was the return on equity. Remember, this is number 1 calculation for cost of equity. And now we have, look, this is lower. This is lower than 5.27, right? Because we added debt and it's a lower risk. So this goes down. So there's another advantage to bringing on bondholders. It looks like we'll be more likely to take on investments because you're lowering your required rate of return.
And that lowering of required rate of return is due to the after tax.
It's due, no, not just the after tax. It's due to the fact that this is low. Actually, it's not lower than this. That's funny. But yeah, in this case, it's due to the after tax because that will bring it down to below 0.0527. Usually, this is much higher. But in our case, our estimate with in that very strange period of time made that actually just as small as this. Yeah. Yeah. All right, so then I recalculate the NPV, which we already know is going to tell us still to invest in the Bahamas project because the internal rate of return didn't change. It's the same values from the cash flow projections. So we still invest. All right, so this is like our calculation number 4. So we had so far, we did 3, right? We did, yeah, number 1 was current historical data. Number 2 was 80 years of historical data. And number 3 was dividend growth model. And now doing the WACC, introducing debt is number 4. So this is the 4th estimate for the cost of capital. So all your assumptions will change the number. You know, you have to make the assumptions, you have to make the right set of assumptions, and it'll change your estimate in practice. Here in class, I'll tell you what to do, so you don't have to worry so much. But in practice, you have to come up with the different approaches. All right, this will be the 5th estimate. What if the Bahamas project is more risky than UAIR? UAIR, remember, the beta was 1.552. What if we estimate, I actually put in the case 3.5, but then I calculate, what if we think it's really much higher? We go back, we look at other firms, other airlines that are going to Bahamas exclusively, and we put all that data together and calculate their beta. And we make some other, you know, considerations, and we say, okay, the beta of actually going to the Bahamas is 5.5. It's very risky. All right, so that's, remember, sensitivity, right? If the market doesn't do well, nobody's going to come to the Bahamas. Nobody's going to do well. It's just not, Bahamas is not a choice when people have, you know, when things are not looking great. So it's very risky. So let's now re-estimate the WACC. So putting all the numbers in, it goes up, right? So it's more risky, a higher required rate of return. And now what? What is the conclusion? So this is estimate number 5. What is the conclusion now? What is the number we're always comparing it to? The IRR. Excellent. Excellent. That's all I want you to remember. So we're always comparing it. So now what happened? So now with this risky beta, so there, all of those different variables affect the calculation, is the point I'm trying to make. You have to come up with a rationale to choose the variables that you're going to put in here. And in this case, it tells us, it warns us, do not pursue the Bahamas project. And then I just ask you, so I just ask you, what is the effect? So now, you know, you guys are now taking this class at a time where there's inflation, the federal funds rate and the T-bill rates are going up, but for 10 years, they were like 1%. And so this exercise shows that they're very low, right? I use 1% in my, right here. But, and when they're low, like for 4 out of the 5 estimates, we accepted the Bahamas project. Right? And that's has to do with this being quite low. Also, obviously it's here, so it affects things here too. But if there's not much of a difference between the market risk, if there's not a high market risk premium, then you're going to accept a lot of projects because the required rate of return is low. So that's how the low T-bill rate was supposed to incentivize investment. And now what do we have? Inflation. So now they want to cap down inflation. So anyway, go on.
If we had used, let's say, a 4%,
it would have been really high, and we would have rejected UAIR. I mean, that Bahamas project.
That 0.01 would turn to 4.
Yeah, and this would be 14%. Okay, so it's very sensitive to all. It's sensitive. Obviously, beta is picking that up, but there's also these other variables and circumstances that play into this. So I've given you 5 different calculations with 5 different sets of assumptions, just to show you that you need to make many considerations. And, you know, in practice, you get better at doing this. In volatile times, you have to make, you look at what other firms have done. You look at, in this case, you know, trying to calculate the beta for Bahamas, we had to look at what other firms were doing. But what about startups that don't have industry data? So startups it's a whole new industry, you know, a whole new invention. Who are they going to get data from? So they make many estimates, they make many guesses and proceed. All right, with caution. All right, so here's the problem I want to do. So what if you have not just 2 assets, not just equity and debt, but I partition, I have 2 different types of equity. I have preferred stock to look at and common stock. So these are the ratios because I have, you know, three different assets.
I'll move that and prefer.
Right? And then, so debt still has this 1 minus TC because there's that extra advantage of being able to deduct interest payments to bondholders. So what's the difference between preferred stock? Preferred stockholders are guaranteed a dividend. They can be, I mean, depends on what the terms are, but normally we see a guaranteed dividend payment. Common stockholders don't have a guarantee. They're residual claimants, right? So let's do the final exercise. We have an hour. We have some time, hour and a half. We can do it. You ready?
We're gonna do that one exercise, one from.
What's that?
We're gonna do the whack exercise, or are we gonna do something?
No, we're gonna just do the whack exercise and then we're gonna go because this is gonna take a long time. This is the last, or the second last exercise. Oh, let me show you here. Yeah, I think it's the last one here. Okay, so hi, Daviada. All right, so this is the second last handout or assignment or exercise in the platform. So you have here common stock, preferred stock, and debt. And we're going to unravel this information. Did anybody do this already? Okay, so let's first work with debt. What is the information here for debt? I'm going to underline it. So okay, so the debt book value of debt 736 million. And then about debt, it says the interest on debt is about 72 million per year with annual payments. And debt is worth $834.18 per $1,000 bond. And that's it. So from that information, you should be able to find RB and B. Go for it. So put that information on on a sheet of paper. I did it here.
It's 736 plus the $72 cost. Hold
Just trying to find a clear one. Just keep working on it.
What do you do with this? Years.
Well, you figure it out, because I know, I'll show you in a bit. You guys work on it. Think about it. So you have the book value. Is 736 million. What is that information useful for? Why did I give it to you?
If you want to continue the project or just sell it.
No,
Close?
that's not why I gave you that information, but what do you do with that? What does that tell you out of the balance sheet? What does it tell you? 700, so what's the face value of the bonds?
1,000.
So how many bonds are there? So face value is what's in the balance sheet, right? So there's 736 million, so that means there's 736,000 bonds. Oh, why can't you see? You can't see. Oh, because there. Because that's what's on Zoom.
And then take those 736,000 bonds and then put them in today's money, which is the current of the debt.
Okay, so go on.
So we have to take those 736 36,000 bonds and put them into these ones. And
So you want to find B. So what's B? What's the market value? Market value is B. So what's B? What? 834 is what?
That's the amount of the work.
They were, 1,000
Did that. This is 834.
So what's B?
613 million.
$613,000,000.
613,956,480. That one. What should we get on that?
So find RB now.
That's a use maturity.
Yep.
So.
So I have B, so I figured out this. Now RB. How do I get RB? There's not a lot of information left there. So use what you have. What do you have there to find RB?
The interest. On the bond.
And how do you find it?
72,000 million per year annual payment divided by the amount of bonds. So we'll have the annual payment bond per. So it's $97.83 per year for bonds.
So what do you do with that information?
Uh,
That's not a rate.
that we put in to.
So what do you do with that information, everyone?
Put in, find the.
Not just Christopher, the others? Sorry, Christopher. What is that? That's a payment, a payment.
And I know that's a payment, but that includes interest.
No, that's what the payment is. If you remember back, sometimes it does, sometimes it doesn't. So we have a formula. This is the bond formula. Now you want to modify it with the symbols, but it's the same thing. The price is currently $834.18. The payment is $97.83, and this is RB in here. And how many years is this? And what are the payments? Annual, right? So I can just write it like this. So it's stated in a different way than you're used to, but you have to make it fit what you're used to. So that's the payment. And yeah, it's mixed up. Remember, sometimes you make your interest payments through the coupons, sometimes you don't. So with that payment and that price, you'll find out what the yield to maturity is in per dollar with this formula. Now, you don't have to solve that. You won't even be able to solve it algebraically. You have to use your calculator to solve that. The best you can do is guess. But you have to use your calculator. So how do we put this in our calculator? 20 into n. RB is what we want. Price is the PV. The payment, we know what that is. And then we know the face value, and those are both positive. And now we ask to compute interest, and you get the answer. This answer is on the platform. You don't have to copy it. You should only be writing it if you're solving it, because the answer is on the platform. You should be working on it with me here and brainstorming. Well, what's RB? What is it? What is the number, the value? Can you guys get that?
Yeah, 12%.
12%? So you should store that value because it's a long repeating decimal, okay? So it's a long repeating decimal, you should store that value. So we've got RB and we have B. So then this is done here. We know TC, so that's all done. And now we move on to the next asset class. Okay, so now go through and underline everything do preferred stock first. Underline all the information for preferred stock or separate that information for preferred stock. Yeah, do it again, Daviana. You must have entered something wrong slightly. So we learned several ways of estimating the cost of equity, but you can only calculate it given the information you have. So which way will you use to calculate the cost of equity for preferred stock? What method? Very good. And Daviana, bring your calculator here. Can you come on this side so you can see what I'm doing? Put a negative 9783 payment and then 1,000. Where? Oh, you thought it was not
Yeah.
1,000. Oh. Okay. So I'm going to minimize this, or let's get it again. Okay, so now we're gonna do preferred. So for preferred stock, one million shares with a book value of 1 million. Preferred shares are presently selling $85 per share, a constant dividend of $6 per share. And that's it. Okay, so that's the information you have for preferred. So our goal is to get, we got to get SP and RP. SP is the market value. What's the market value? What's the outstanding market value? It's $85 per share, and 1 million shares is $85 million. And now let's get the RP. RP, now, we don't have a lot of information, so let's see what we have. We have the price. Sorry. And we have the dividend, constant dividend.
use the dollar return for your stock. To calculate the expected return.
You have the dividend. You have the number of shares. Do we have any extra information? This is TC here.
Equity.
So you don't have growth. So it's not the dividend growth model, but you're just going to use the basic formula. So you don't have anything else. How do we value stock? It's just like that. Or we write it now. I'm just going to write it with our notation. Or I'll just write, I just get rid of the expected value and write that. That's basically it. That's the interest rate. That's the interest rate, RP. That's the price, 85, and the dividend is 6. So it's just this formula. You don't need the dividend growth fund because there's no growth, but you use the basic dividend formula. So $85 equals 6 over RP. So RP is
14.17.
no. Why do you have 14? 6 divided by 85.
Zero point two 758.
So what percentage is that?
7.1. 7.1.
Well, you need to store all the decimal places to get my answer. So 7.0588 235%. So we have RP and SP. And store that in 2. And now gather the information for the common stock.
Yeah, on equity book value.
So get the number of shares.
$4 per share, and you can sell it for $30 per share.
And you have a growth rate.
Yeah, and the constant growth rate is at 5%.
Yeah.
But now we need to delete both of this.
Yeah, because you don't have anything else, right? So just go with what you have. Either you can use CAPM. You have no beta here. There's no beta, so you can't get CAPM. You don't have return data, so you can't use the return or average return method. You cannot estimate using the general formula I have for returns and prices. You can't. So this is all you have. Dividend growth model or the basic dividend formula there.
So there were always 4 or 5 ways.
There's 5 ways. The way I've taught you is like four different ways for returns, right? Either you have a whole bunch of different return data, like you have time series of returns and prices, and you can estimate the return at any point in time. That's number 1. Number 2 is a dividend growth model. Number 3 is CAPM. And then from CAPM, you can make different assumptions, a bunch of assumptions to calculate it differently. From there, with the return from the CAPM, you can also use it to do the WACC, which is just the average returns for bonds and debt. Bonds and equity. So we're doing the WACC right now for 3 assets to show you that there can be many asset classes that you combine into a WACC. Okay, let's do the last one and then put it together, which is just an exercise in endurance because it's just a lot of numbers. So let's get the last one. So you guys are going to agree it's not so hard? It's basically the same thing again and again and again.
It's the same thing, but the thing is that we have to read a lot and see which formula.
You have to practice a lot. You have to practice a lot. So, okay, common shares. Common shares. So you have book value, okay, common equity, 44 million shares with a book value of $1 billion. And then common shares pays dividend with growth 5%. Okay. The book value is $1,421,000,000. And there are 44 million shares. So now the market value, SC, is equal to it's $4 per share times how many shares?
32. For 44 million.
And what do you get? It's, did I do it right? 44 million?
Yeah, 136 million.
Is common stock? Oh, that's the dividend. I got it wrong. You're right. You're right. I got it wrong. I wrote the value is $32. Thank you. Yeah, I wrote it wrong. I read it wrong. 32. So
uh, 1,408,000,000. So
yeah, 1,408,000,000. All right, we have market value, sorry. We have SC. And now we got to get RC, and that's not hard because we had a little discussion about it. All we have about the price, we have the price and we have the G, right? 5%. And the dividend. Their annual dividend. So it's very basic here. So that we use the basic formula for dividend growth model. Well, the dividend being constant, growing at a constant rate. So we use this formula, but we're solving for this. And that's going to be our RC. So price was 32. C1 is the $4. This is going to be called RC, and G is like that. You guys feeling better? Okay, so we're just using everything we learned. Like, I'm not teaching you new things, like new applications of things you already know. So 432 plus 0.05 is RC, and we get RC. Uh-oh, stop. I made a mistake. Because it pays, it says here, I was rushing. It paid this year, $4 this year, but next year, how much is it going to be?
5% more.
Thank you.
What?
Yeah, so we have to apply the next one, because it's always the next one, right? So this is the price today, it says. Does it say that?
yeah, yes, that's 33.
And then, so that's next periods is going to be next period. That's my mistake. So this is 1.05. Does that make sense?
Yes.
So it's just because I read it fast, and wrong.
It's 0.18125.
Okay. So that is our C. So you have all of the things here with 50% tax rate to calculate the WACC. Do you want to try that? So let me put it all in one slide somehow. Are you guys putting it together for me? Lost my original. I'll just go with this one. Okay, so this is debt, if you can see it. Preferred and common, and you have to put it all in this formula here. But it's on the platform, but you can copy if you want.
Yeah. Professor, and your position today is going to be for the.
I said it would be from 3 till 6 if you want to write exam 1 again, or if you want to write the second part to exam 2. So are you guys gonna put it together or you guys just trust you can do it?
They have just added everything, like,
You gotta put it all together with the formula here.
just adding it together. But
It's not added, it's, you gotta make this, you gotta make each ratio. That's why I'm telling you to do it. You gotta do it. If you don't do it, you're not gonna know how to do it. You gotta make each ratio.
How long is this final exam, Professor?
I don't know yet. It's 3 hours. That's what you have. I didn't make it yet. I said I would put an old final up, but I'm not sure I'm gonna do it. Well, you guys should practice making the ratios anyway. It's like 45 minutes, I think we spent on it. Daviana, what's that? You store them and then you bring them up when you want them with RCL. So you can store all of this.
Professor Williams.
So if I was gonna store this one. Okay, so 20 years. Interest is what I want. PV was 834. 18. Negative. 97.83 is the payment. Future value is 1,000. And I compute the interest rate and I store it in one. It's a percentage, so I have to be careful about that. I'm gonna divide it by 100 and put that in instead. So store one.
If we're going to store it, this particular exercise, what always we have to store it.
You should store it because it has all the decimal places in the calculator. It has more than 9. It has all stored in. To get my answers, you need to store. Or you're gonna get different answers than me and get frustrated when you study. Then
But I have to store it. Not as the percent.
I think you should store as a decimal, but you need to remember, whatever you do, you need to remember. So this will be stored 2. And then this one, 4 times 1.05 divided by 32 plus 0.05. Store 3. So I have them each stored 1, 2, and 3. I have to remember or make a note about it. And then let's calculate the different ratios. And I can store those in 4, 5, and 6. Let's see if I get the right answer. So for the ratios, for SP, I'm going to start with 85 million. To 3, 4, 5, 6, divided by, with a bracket, 85 million. 1, 2, 3, 4, 5, 6. Add common stock. 1,408,000,000, 1, 2, 3, 4, 5, 6, plus, and then B. 613,956,480, close my bracket. Equals, so that's my ratio. I'm gonna store it in 4.
That's the first ratio, right?
That's my first ratio. I don't know if I did it right, but let me see.
And then que no primero, porque después de estos ratios, tú vas a tomar ese tu weighted average. That is the ratio.
And then the value of common stock is 1,408, 6 zeros divided by bracket. So what you can do is store the denominator in your calculator. So it's going to be 2,106,956,480, which I can store in, I'll store it in 0. And then I get that second ratio. I think that's too high. I'll do it again. So recall 0, that's my denominator. So I'm going to take the denominator and flip it and times it by, what am I doing again? Common stock. Common stock value was 1,408 million. It is that. So that's going to be stored in 5. And then finally the debt. So I'm going to store the denominator, which is SP plus SC plus B, and I'm going to store that in 0. Because I have to use it again and again. And then in 6, I'm going to store the debt. So I'm going to recall 0 and flip it and times by the debt outstanding, which was, I think my debt was already, I think I did debt first, didn't I? Because it's a denominator.
Yeah, but.
And then I multiply it. You guys, I cannot hear Daviana, and I know you guys want to talk, but whisper or something, because Daviana is asking me something. Okay, go ahead.
I can't take the V that we calculated and just divide it by this one amount. That is not.
1 second.
We're going to be one, right?
Yeah.
Oh. Anyway, I lost track, you guys. I'm sorry, I lost track. Daviana, I have here the weights that I'm putting in storage. And I put here the total. That's the total, that's the denominator, and I'm using it each time to get the different amounts. So for preferred stock, it was 85 million. So I'm going to put that in first. 1, 2, 3, 4, 5, 6 divided by recall 0, and that's the first one. So I put it in store 4.
How do you get that number?
This is why you guys are gonna practice, because you need to know where these, that's the sum of the total of the bottoms.
So can we use the Excel in order to sort of put in the.
No, well, if this is on a test, you don't have Excel, so.
If we had Excel, it's easier, like, if you're gonna have sort of the, let's say, RP.
Right now, you guys can do whatever you want to calculate it, but me doing it doesn't help you. You guys have to practice. So practice calculating it. If you are interested in doing the CFA exam, you gotta put it on your calculator. You don't get Excel. You have to put it on your calculator.
You take it and sit down, how long? is it?
I
6
don't know.
hours?
I don't know if it's 3 or 6, and there's 3 levels. 3 levels, 3 different. I don't know, 3 levels. I don't know if there's more than 1 in each level.
I'm just saying, like.
Why? Why wouldn't you want to do this? You're just learning. It's hard when you're learning.
Yeah. Then we have to find out.
Once you're an expert and you practice, you're really good.
Yeah, because I understood, this one understood that the actual process of.
That's why I'm forcing you to do it once. Do it once and you're gonna feel victorious, and we still have another half an hour, 45 minutes.
Is that the one?
No, I want you to finish this one,
After we finish it.
finish this one, and we can talk about doing something else, but finish this one, because you're not gonna understand it unless you do it at least once. Efren, tell me. Oh, I thought you were gonna ask me something.
But my question to you is, okay, you added every. Support. When I was going to the bathroom, but you added every single denominator for the stock, and you added this preferred stock and the common stock, you add it all together, so that's gonna be your denominator.
Yes,
right?
and store it, yeah,
Store it.
and store it, so then it's easier, way
Yeah, because
easier.
you have to put it on the first two, and then the tax rate, and then the other ratio. Okay.
Now go to the bathroom. But if you do it, it's gonna be more memorable than if I do it. So you want me to tell you what to do?
I mean, no, okay.
It's gonna be SSP. So it's 85 million plus 1,408,000,000 plus 613,956,480, and then store it. That's your first step here. Store that. And then go one at a time and store the results each time, and then multiply straight through. So we should do something else too. It's true. Christopher's right. We should do something more cost of equity, like one of the other exercises.
Can we do one that's.
All of these are exam questions, all of these that I'd give you.
Simple, but that helps us understand the process.
Well, the simple one was in the notes. This is the more realistic,
This sum of every.
Yes.
all the parts, yeah. So maybe, I'll continue and I'll put some numbers. So far, we all have the same numbers. The basis, the V, which is the denominator, the value of the firm, this is the value of the firm. So this is,
So.
being able to do this it helps like in negotiation and mergers, like this is how you figure out what a firm is worth.
So V equals SP plus SC plus B.
Yep. So what do you get?
So we're gonna trust.
It's gonna be,
2,106,956,480.
So you store that in 0. And then you get the different ratios.
And then you divide 85
Mhm.
to billion. Okay, so is the 0%?
No. Which one are you talking about?
The whack.
Oh, the whack. Yeah. I thought you were talking about just the first part. So this is my total and I flip it to make it denominator and I multiply it by SP. SP was 850000000. So that's my store 4. That's going to be the first ratio. So this is 40%. Not just the top, but the whole thing. And so you store that in 4. Then you go to the next one. Common stock. Common stock is 1,408,123,456 divided by recall 0. So this ratio is 66. And I store that in 6. Not there. No, not debt. Sorry, in 5. So store in 5. And then finally 6, I'm going to use the value of debt. So over here. 613,956,480 divided by recall 0 is 29%. Now those, you made a mistake if you're over 100, right? These all have to add up to 100. And I store that in 6. So I should also have stored all the rates too.
Yeah. What's in
1, 2, and 3. I can't remember now.
Yeah.
Did I store them in 1, 2, and 3? Yeah.
2 and 3.
Okay. So I'm gonna go with P. So this is store 1, store 2, and this is store 3. Okay, so everything is in my calculator and I'm ready to do this. So recall 2 times recall 4 equals I'm gonna just store 7 because I don't want to lose it. Recall 3 times recall 5 store recall 1 times 0.6 times recall 6, store 9. So recall 7 plus recall 8 plus recall 9. Okay, so it's a good exercise. It's like any exercise. It just stretches and strengthens your muscle. It might be harder than what's on the test, but you have practice. I just said it might be harder than what's on the test because it's very long.
Is there a 6th unit?
No, obviously there's no 6th unit.
So that final exam will be.
You guys not read your emails?
Yes.
You don't read your emails or you don't have a memory. I send you all this information. Because, I mean, anyway, Daviana,
But we get like 5 emails from different things that don't have to do.
that's true.
So that's.
Write it down. Daviana, your question. I hope that's the right number. I never had a chance to check. Let me check.
My question is the last.
Yeah, 14,11459.
Why do we have this here?
Because return on debt is tax deductible, so it goes down because they don't have to pay RB. They're gonna reduce, the firm's gonna reduce its tax by RBTC. I do the calculation and I talk about it on the video today and I talk about it on the other video. So basically that's because of interest tax deduction for interest payments to the bondholders.
So this is just the tax calculation.
That's what, yeah, it's it'll be 0.5. Oh, how did I get the right answer when I used 0.4? I think I used, for the last one, did you get the exact same thing, Chris? Did you get the same number? And did you use 0.5 here?
What?
Like, I feel like I used 0.6. How did I get the same answer? Okay, should be 0.5.
Lo que hicimos fue esto y pero no nos dio.
What happened?
Sí,
What's Wednesday? I said we would, no? You misunderstood. What did I say? No, Wednesday. No, I never said that. I said that? Was I in a delusion? What, when did I say that? When I walked in? Wait. You guys are all thinking the same way. That's not what I meant. I meant that maybe I said Wednesday, but I was talking about Friday because they are. You guys all heard Wednesday. I was talking about Friday. They were going to make us have a class on Friday. And who's going to do that? Which professors are going to have class on Friday after the exam? Like, it's past the last day of classes. Like, I can't believe they did this. And I'm not in that meeting. Oh, it's on recording. It's supposed to be in a meeting right now, but I didn't go. No, I thought it was more important to come here.
Yeah, because I just wanted to know because.
No, I didn't say Wednesday. Did I actually say the word Wednesday?
Yeah.
Yeah, we have the recording. No, Friday. Wednesday's good. Wednesday's good.
Because you have the formula sheets from the past exams and.
You want to use the same one? Make another one. You gotta make another one.
I can
It's
kind of
part
make
of the exercise.
But
Did you not take a picture of it?
some of them. And also, I assume that way you're gonna.
If you come to my office after this, you can take a picture of it. I have it in my office, so you can take a picture and then reproduce it.
What if we do a combined exercise?
I assume that.
Wait, Chris is on a different wavelength. What, go on, finish?
I assume that also on Wednesday you're gonna give us the grade for the third one.
Hopefully, I don't know how, but hopefully, I have way too many things going on. It's crazy, but yeah, I'm gonna do my best. Chris,
Extremely long.
No,
exam,
no.
and then we do it with the class.
Oh, yeah.
Okay,
I thought it was something else.
but did you guys look at all the exercises I put on the platform? This is just one of the exercises. Did you look at the other ones? Why do I have to give you more when you have enough? Chris, they need to look at the other exercises still. There's so many problems they haven't looked at yet.
Ok, porque quiere que como que haga, ok, dé como 3 ejercicios. Y que hagamos, y lo haga así mismo y lo hagamos grupal.
Como trabajo final.
Como en vez de.
Pero yo creo que
No, it has to be individual, has to be individual.
I mean.
Has to be
okay,
individual.
I understand it better cuando como que, mira, what do you have? Me está dando este problema, I'm wrong with this, me explica.
Yeah,
This is wrong.
Sorry. I used to give these questions as assignments, but there's no time to grade assignments and tests. And that's why I don't have assignments, but that's why I put them on the platform so you guys can do that. You guys can get together and you guys can work on all the exercises there.
What if you give us an assignment, they, as a 2 day, for example, in the exam period, we can give them the reviews and assignment from this. topic
No.
completely, or individual.
We are already behind. We lost a unit. No more changes or breaks or anything. Just learn what's there. Okay, let's see what else I have on the platform. So are you guys gonna practice this? Some of you finished?
I finished, but I didn't get the,
You didn't get the answer?
but I was seeing this.
Hold on a second, Isaac. So, excuse me, so there's these other exercises here. Oh, I got kicked out. Did you do this one already? I mean, you guys have bigger problems, right? You have other problems to do. What about this one? Did you do this one?
Let's do one.
So these are all, but you have the answers. So you guys work on it and I'll stay here. Look, all these problems. These are all exam problems.
Could we do one, Professor? Like, what's the simplest one of that one? If you
Exactly. You have a question? Oh, you're just working. You're working on it?
Yeah,
Go away from the cables because the cables are sensitive. Just go here. It's okay. It's just ridiculous that they're so sensitive.
because I'm lost in the last.
Okay, so I'm gonna stop my recording here. Everything froze. Frozen. One moment. My Zoom froze. Everything's frozen. What am I doing wrong? Sorry.
assume that you pass us, the attendance.